All right, it is Tuesday, February 3rd, 2026. About an hour ago from when I'm recording this, the financial markets didn't just sell off. They did something that looks and feels like a structural breakdown. Not normal volatility, not a healthy pullback, a break in the plumbing. Gold dropped roughly 8% in about 60 minutes. Silver was down around 12% in that same window. And in the space of roughly half an hour, you had an estimated $5.9 trillion in precious metals. Market value get erased like it was nothing. 30 minutes. Let that register. That's the kind of number you associate with entire nations' output, the kind of value that takes years to build, and it got wiped in the time it takes to order a pizza and argue about toppings. And here's what makes it crazier. This wasn't isolated to metals. Bitcoin dropped about $2,700, and the liquidations rolled through like a wave, roughly $356 million in longs gone in the same hour, and close to $100 billion wiped from the crypto complex. Meanwhile, U.S. equities took a direct hit. The S&P shed hundreds of billions in market cap today, the Nasdaq slid hard, around 2.5%, and you're talking about another $700+ billion evaporating there too. So if you're sitting there wondering, how can everything be red at the same time? That's the correct question, because when the traditional diversifiers fail together, you're not watching normal price action. You're watching a system trying to raise cash. Quick and serious reminder, especially for anyone new. I do not sell signals, courses, mentorships, or paid groups. If someone is pretending to be me and asking you for money, it's a scam. Block them immediately. My only presence is on YouTube as Asian Money Guy. That's it. No assistance, no VIP, no private DMs asking for payment. Protect yourself. And for the new people, I do not sell signals. I don't sell mentorships. I don't sell courses. I don't have a paid inner circle. Nothing. I'm not here to farm your fear, and I'm not here to feed you greed. We break down the full picture. You think for yourself. That's the deal. Now let's talk about what just happened, because this move is off the charts historically. This isn't a bad day. This is the kind of move that makes professionals stop and stare at the screen because it suggests the mechanics of the market failed under stress. I want to start with silver, because this is where the story gets genuinely bizarre. Silver just tapped the 150-hour exponential moving average and hit about 30 RSI on the hourly, oversold territory. And here's the part that should make your eyebrows go up. That flash crash didn't just bounce near the 150-hour EMA, it bounced right off it like it was a hard floor. Exact. Clean. That's now the third time in recent weeks we've seen that area behave like critical support. And the reason that matters is simple. Above the 150-hour EMA, the structure is still intact. It's still bullish but violent. Above the 2-month uptrend, you can argue the market is absorbing stress, not failing, but below that uptrend, the character changes. You don't immediately go bear market, but you do enter the zone where large pullbacks become not just possible, but probable. Long-term still bullish, but short-term starts getting scary. Now, the primary uptrend line you should care about sits down around $91. That's the if we lose support, where does price naturally want to gravitate level? And the key point right now is we haven't broken the 150-hour EMA yet. We held it during a move that just vaporized trillions. So ask yourself, what does it mean when a market holds a critical technical floor during what looks like a forced liquidation event? It means the sellers might not be real sellers. It might be liquidation, not conviction. Now connect that to the physical side, because this is where the story stops being normal and starts looking like a split reality. The Shanghai silver premium is sitting around plus $25, $25 over spot. That means physical buyers are willing to pay $25 above paper reference to get their hands on actual metal. So the paper price is collapsing while physical premiums are screaming higher. Does that sound like equilibrium to you? Because that's not equilibrium. That's a market in conflict, a market where price is being discovered in two different places with two different truths. And it gets more interesting when you look at delivery activity. There were hundreds of delivery notices issued late last week, and now that January has closed, the month ended with deliveries totaling roughly 9,954 contracts, which is about 49.27 million ounces. Read that again. Nearly 50 million ounces moving through delivery mechanics while price is getting slammed. So let me summarize the contradiction in plain English. Delivery demand stays hot, Shanghai premiums stay elevated, and paper price just dropped double digits in under an hour. That's not a demand problem. That's not silver is suddenly unwanted. That is the disconnect between physical reality and paper leverage. And this is the point people keep missing. When gold and silver, the assets people are told to run to when everything else falls apart, when those assets vaporize trillions in minutes, that's not automatically weakness in metals. That's a sign that something is broken in how they're being priced in the short term. because in a true liquidity event, funds don't sell what they want, they sell what they can, and gold and silver are liquid, widely held, and for many institutions they're sitting on profits. That makes them the first piggy bank to smash when the margin clerks call. So what triggered the carnage? The crypto tape gives you a clue. During the crash, the order flow didn't look gradual. It looked like someone yanked a lever. Big blocks hit, liquidations fed on themselves, and the wave rolled outward. Bitcoin, then equities, then metals. Whether that was coordination or just panic contagion is not something I can claim with certainty in real time, but the outcome is the same. Instantaneous deleveraging. And when you see multiple asset classes dumping together, that's usually not investors choosing to rotate. That's forced selling. Collateral stress, margin calls, risk models tripping, systematic de-risking. Now here's the question that's on everyone's mind today, and I'm going to say it carefully. Is this a preview of something bigger geopolitically? People are whispering about the Middle East. People are asking if this is a foretaste of a broader conflict. If that escalates, what's the first thing that turns green again? I'm not going to sit here and tell you war is definitely coming. I'm not going to claim this crash was definitely caused by geopolitical tensions. I don't know that, and neither do you. Not yet. What I can say is that extreme synchronized moves like this often show up when the system is already fragile, and then anything, hits it at the wrong angle. So let's reframe the entire event with one observation that matters more than the headlines. Look at the percentages. Gold down about 8%, silver down about 12%, equities down far less on a percentage basis. But the dollar amounts wiped look weirdly comparable across buckets. Silver gets hit hard, and yet the market cap loss stacks up next to what the major indices lost. What does that tell you? It tells you the leverage and positioning in paper metals was massive, enormous. If you can erase comparable amounts of value with a much larger percentage move, it suggests the paper side was stretched tighter than people realized. When the collateral disappears, metals get hit harder because the leverage is more extreme. That's not fundamentals collapsing, that's paper structure snapping. And that's why the Shanghai premium and delivery flow matter so much, because they're the counterweight to paper chaos. They're the part of the system that doesn't care about margin calls. A refiner doesn't care about your liquidation. An industrial buyer doesn't care about your stop loss. Physical demand has its own logic. Now, I'm not going to pretend this is bullish sunshine all the time. The bearish case is real, and you need to hear it without sugarcoating. If the 150-hour EMA breaks, if we lose that support level and we don't reclaim it quickly, the next destination becomes the primary uptrend around $91. That's not a small move. That's another meaningful drop from here. And if equity markets continue falling, if we get follow-through liquidation, metals can absolutely get dragged lower in the short term, even if the long-term thesis remains intact. That's what happens in liquidity events. You get the first shock, then you get the aftershocks. And the next few days can be brutal, not because the story changed, but because positioning has to reset. And here's the risk statement you need to take seriously. If you're trading this on leverage, if you're using options, futures, high beta products, anything that can force you out at the worst moment, this environment can wreck you. Margin calls do not care about your thesis. Forced liquidation does not care about fundamentals. If you're overextended, you can get wiped out before the market even decides what direction it truly wants. But here's the other side, and this is why, despite all the chaos, the long-term structural setup doesn't magically disappear today. The bullish factors we've tracked for months are still here. Physical demand behavior is still here. Premiums are still here. Delivery flow is still here. Industrial demand drivers don't vanish overnight. Central bank gold behavior doesn't flip on a dime. The debt trajectory doesn't fix itself in an hour. Monetary instability doesn't resolve because the chart went red. What changed today wasn't the long-term story. What changed today was the paper price getting obliterated by forced selling. And if you've studied any major crisis period, 2008, March 2020, you know the pattern. Precious metals can get hit in the initial panic because everyone scrambles for cash, and then later they decouple when the system starts responding with liquidity, policy, and stimulus. I'm not saying that's guaranteed. I'm saying the pattern exists, and today looked like the kind of event that produces that pattern. So what matters right now? It's not the drama. It's not the noise. It's the data. Watch whether physical premiums hold or expand. Watch delivery behavior. Watch whether the 150-hour EMA continues to act like a floor. Watch whether we base and rebuild, or whether we lose structure and slide toward that primary uptrend. And understand the core truth that today, exposed in a way even casual viewers can feel, paper and physical can diverge, and when they do, something eventually breaks. Historically, it's not the physical market that breaks first. So I'll leave you with this, and I want you to take it seriously. If you don't understand the risks, if you don't have a plan, if you're over-leveraged, this environment will eat you alive. That's not fear. That's reality. But if you've been building intelligently, If you understand what you own and why, and if you're positioned for volatility instead of pretending it can't happen, then today might end up being a violent shakeout. Not the end of the story. Time will tell. The next few sessions are going to matter. If this kind of real-time framework helps you cut through the noise, make sure you subscribe. And if you want, drop Asian Money Guy in the comments so I know you're part of the group that values clarity over hype.